watching Stockwatch. I'm Simon Brown. Joining me to unpack your stock-related questions today, Alex Duys, Umthombo Wealth, Chantal, Marx, FNB Wealth and Investments. Be sure to send your questions through email, stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV using hashtag Stockwatch. Lady, gent, appreciate your time today. Chantal, let's start with you. We've got the question, so we'll get to it first. Sasol results. Finally, we get some numbers. A lot of moving parts in it. I even went and read the analyst's document that they gave us and everything else. I mean, was it better, worse than you'd expected? Is this time to buy Sasol?
Yeah, I mean, every single note that I saw coming through internally and externally said that it was in line. And I think what we got clarity on was basically cash generation, which was poor. So I think it was pre-guided pretty well. The market was expecting a bit of a bloodbath. That's exactly what we got. Whether or not this is the worst of the worst, I think remains up for debate, because a lot of the issues that they're facing aren't easy to fix. Feedstock availability is going to remain a risk for them. Weak oil prices could remain a risk for them. Reliability at their mines remains a risk for them. So all of these things, I think, will make it a little bit more challenging to be invested in the company than it would have been 10 years ago at this price. So I'm still staying away for now. I like my earnings visibility to be clear. So it depends, I guess, on what your risk profile is like.
Yeah, and 10 years ago it was 415 Rand. It's now 90. Alex, your take on Sasol. I mean, to what Chantal says, I mean, there's a lot that is going against them. There's a lot they can't control. I mean, the commentary around chemical prices, they point out they are price takers in that regard.
Yes, I concur with what Chantal said. I mean, but saying that, if you look at the valuation, it does look, sure. I mean, the market cap is pretty much about $3 billion.
Yeah.
So if they can turn around things, and let's say the fundamentals do improve and cash generation, increases from this low base, then it's a very interesting proposition. But I think that's quite a low probability outcome, unfortunately. The free cash flow generation is still very, very poor, and they've got this huge debt pile they need to get under control. They're trying to reassure investors by saying that dividends will come back if they're at certain levels. But I think, honestly, they're quite far away from paying decent dividends as well. And if you compare that to global peers, I mean, cash profile return from Sasol is very poor. So my question is, who's going to be the marginal buyer for this business? Because foreigners will certainly not buy this, and even local South African investors, to some extent, have capitulated. So I think they do need some luck. They can try to improve the operational efficiency, as Chantal refers to, but at the end of the day, they'll need some luck. And hopefully the prices move in their favor, they can get some cash and they can, de-gear. But other than that, it seems a bit of a binary outcome for me, unfortunately.
Yeah, and I mean, luck is not my favorite investment strategy. Alex, let's stay with you. It was a couple of years ago, I think it was 2019. Prosus tried to buy Just Eat. Instead, they merged with Takeaway.com. Prosus is now looking to buy the both of them, Just Eat, Takeaway.com, 4.1 billion euros, premium of 63% to the price of Friday. The market hasn't liked it. Your take on the proposed deal?
I've never really been 100% convinced on the food delivery business model. Now, if you look at Just Takeaway, the share price is, at one stage was almost 100 euros. So it dropped to about 50 now. I think they're paying about 20. So it's still far off from where it used to be, but there was a lot of air in those valuations. Let's call it that. I'm not that close with this business, so we're going to have to spend some time studying, see the fundamentals and what exactly offers and where the opportunity is. But they are predominantly in Europe, so they see that as an opportunity to the overall basket, and they want to pay for it by cash. So they seem to be optimistic, but I think why investors are a bit concerned is capital allocation. I mean, simply buy back your own shares, or I think seems like a much better proposition. But at the same time, we know that this new management team is being incentivized to create value, specifically also to get the rump value up. So perhaps that's part of that strategy. Time will tell if it's going to be a success or not.
Yeah, Chantal, my problem with the delivery apps, I like them, but there's no stickiness to me. What's your take on this potential transaction? 4.1 billion euros, which is less than they were going to buy just one half of it 6 years ago.
Yeah, I mean, if you look at food delivery, I think if you asked me 5 years ago, I would have said silly, shouldn't get involved. I was quite relieved when they actually didn't end up buying or scaling up or adding food delivery to what they already had a few years ago. But since then, we've actually started seeing profitability improve quite a bit for these guys. So where I couldn't see a pathway to any of them being profitable, a lot of them have improved profitability. The biggest issue, I think, facing Just Eat has been they haven't been able to really grow their revenue line. So profitability improves, but the revenue line isn't growing. Now, hasn't been a problem for Delivery Hero. I like the fact that they're adding scale to this business. I actually think they can take a whole lot of additional costs, particularly at head office level, out of it. So still, I think a gap to improve profitability. And now that we're starting to see these businesses becoming cash generative, I'm actually more on board. In terms of the strategy to bulk up, and to actually buy something of this size, I think that's kind of what we should have expected when the new CEO came online. I mean, this guy's a deal maker. He's a grower of businesses, and I think we shouldn't have been surprised by this. I guess time will tell whether or not this was a decent allocation of capital, and I absolutely take that point. I mean, maybe it makes more sense to buy back more shares. Maybe it makes more sense to invest elsewhere, but you need a lot more than just buying back shares in order for us to see that discount narrow to the intrinsic value for Prosus and Naspers. And maybe this is a start.
Yeah, no, I take a point in that. And certainly they are profitable, which is, I did not think they would ever get to that point. TSMC, Taiwan Semiconductor Manufacturing Company, question coming through. Any reason not to be buying it at this point? Chantal, I mean, listed in, well, operational in Taiwan, but of course listed all over. They are the chip maker of note. Cleverly, they just do it for everybody else. TSMC?
Yes, so I mean, they make chips for everybody else, and that therein lies the biggest risk, I think.
Can get in a situation like this is that the market tends to be cyclical to a certain extent. We've got the structural support now from AI, but it still tends to be cyclical to a certain extent. And the biggest reason for that is that you get kind of channel inventory stuffing. So a lot of the guys that they sell the chips into will actually hoard chips, and at some point they will have more than enough. So that generally results in lower orders, and that can pressure revenue and in turn margins, and the impact can be quite big. The other issue for TSMC is that in order to scale and increase production, they have to spend a lot of money to build foundries. It's a very intricate manufacturing process, and it's very expensive to get a new foundry or factory off the ground. That said, TSMC does have the structural support from AI. It is the leader in leading edge technologies when it comes to chip manufacturing. We don't think the stock looks expensive at the moment. A lot of their development spend and big capex spend is now kind of behind them, and it's probably going to taper over the next few years. So yeah, I mean, I still like the company. It's just important to know the risks involved.
Yeah, I take a point. And they have been expanding. They got, I think it's Arizona, they got a plant in Germany, their foundry as well. Alex, TSMC?
Yeah, the viewer that asked about why not buy, and I think the biggest risk remains geopolitical regarding TSM because it's based in Taiwan.
Yeah.
Right, and we know what China's ambitions are, and they do see Taiwan as part of them. So I think that's the real major risk, and obviously, pretty much the West and East are fighting for those chips. So they are, I guess, in the middle of a potential, call it war, Cold War type scenario. But other than that, I agree with Chantal said. Business is very well positioned and will continue to be dominant. And I don't think it's expensive. And in fact, a lot of Taiwanese stocks, haven't done particularly well over the last few years.
Yeah, and I take your point. The big risk, there's the sort of hoarding, but there is, of course, that geopolitical. Question coming through around Mr. Price, down some 20% from the highs of late last year. Is this an opportunity, or should we wait for results? Alex, I mean, Mr. Price was one of those SA Incs that had a spectacular 2024, some sort of home truths coming back. Would you be looking at Mr. Price down in the sort of 230, 240s?
Yeah, I think the clothing retailers perhaps ran ahead of itself. I mean, something like Prosus as well went to about 105 or so, ran now at less than 80. A lot of SA Inc., in fact, has sold off this year as well as from Q4 last year. So I think Mr. Price falls into that camp. They most likely will still deliver, I think, decent results. We saw the updates from a sales perspective. November was very strong. December, bit of a slowdown. So I think it's started looking a bit more interesting. It's not my most preferred play within clothing retail, but they do generate very good cash earnings. As long as they stop doing more corporate deals and start betting down what they've already done, I think investment case can be created for Mr. Price from these levels.
You kicked that door open then. Who is your preferred player in the local clothing retail?
Well, from a growth perspective, I would say something like Mr. Price and Pepco, but I'm looking at valuation, and I think the stock that the market loves to hate is Stor-Age.
Yeah.
And I think the cash earnings is going to be very strong there. I think the UK business is unappreciated, and I think there's a real chance they can start doing share buybacks again, because most of the capex speed bumps are behind them. So for me, it starts looking interesting because there's been a bit of a capitulation from shareholders on the stock.
Chantal, Mr. Price in the 230s, 240s?
Yeah, I mean, Mr. Price is actually one of my preferred picks in the SA clothing retail space. That's what makes the market, right, Alex? So, yeah, I mean, Mr. Price, I really like. I think that the capitulation you saw was probably just a combination of profit taking, a little bit of fearfulness because of that soft kind of December numbers that we saw coming through in their trading update. But it seems, and I mean, they forward guided a little bit. It seemed as if things were going better in January. And I do think that there is some decent momentum behind these stocks right now. I agree with Alex. I think that they should probably halt further corporate activity right now, bear down what they've got. So far, it's actually been performing quite well for them. I think Power Fashion is a really interesting business. I think Studio 88 is a nice diversifier as well. So yeah, I mean, I'd still be buying at these levels.
Yeah, and I think they've also got Yuppie Chef, if memory serves correct. Two questions coming through, which kind of the same. They're not stock related. Chantal, let's start with you. Question is, suddenly we've got load shedding again. Should we worry? We should worry. It means I don't have power at certain points of the day. It is no fun. Having my morning coffee this morning, the gentle rumble of generators and smell of diesel was like old bad times. But the question was, is this going to have a significant impact on the market? I mean, much of the market, I imagine, is probably positioned for it.
Yeah, to a certain extent. I think the operational resilience of the South African companies are now kind of embedded, right? Because we had these years of load shedding. So I don't foresee that being necessarily an issue for them. I think there are two reasons why this is a worry. I think it can have an impact on consumer confidence because consumers might start feeling like South Africa is not moving in the right direction anymore. And when consumers are not confident, they don't spend money. So that could have an impact. I don't foresee the load shedding story being a long-term problem to the effect that it was, or the impact that it had a few years ago. So for that reason, I don't necessarily see much of a big impact on, for example, the miners. The other impact that I do see is on foreign investor sentiment. Yeah. So one of the things that we've noted around what we require in order to see another kind of leg up for South African bonds as well as for South African equities is we need foreign investment. We need foreign investors to come back to the South African market. And a few years ago, in the midst of load shedding, we learned that a lot of these international fund managers actually have ESP, Eskom push on their phones so they can monitor load shedding and make their investment decisions accordingly. So they are going to know about this, and they might decide to withhold capital if they were in an advanced investment decision to come back to South Africa, and that, I think, is a concern.
Yeah, I take that 100%. Alex, anything further to that comment?
I think Chantal is spot on. Perhaps just one thing to add is that even though we've come a long way, I mean, for us to really rectify our electricity production, we obviously still need to build a new transmission line so we can add all the new power plants to that. That's still a multi-year journey. So if there are multiple breakdowns like we've seen in the moment, then you're still going to have this every now and then setback. But I don't think you should look to extrapolate this going forward. There's no evidence of that as of yet.
Yeah, no, I take the point. And transmissions lines. Hello, Roynet. Question, the other one, Alex, stay with you a moment. The proposed 2% from the Minister, if it goes ahead on the 12th of March, the increase in VAT, that is, will that hurt retail stocks? I mean, in essence, it's 58, 60 billion that gets pulled out of our pockets. Does it sort of hit retail, or is it not a big enough number to really worry about? Or do they just fudge it somehow?
It will certainly have quite a big negative short-term impact. I mean, you can make an argument if we do grow the economy above 2%, and then, call it in the medium term, then it'll be offset. But for now, it's certainly an expenditure that the retailers will certainly have to absorb. And we just started to see some momentum there, and so it will be unfortunate if that happens. I don't think it's a positive. That's for a fact for retailers or any consumer-related businesses.
Yeah, Chantal, I can imagine you've got a positive spin on a 2% increase in VAT.
Yeah, I mean, again, it's the confidence story, firstly, because people perceive things as being more expensive, so that they just make different spending decisions. And the second thing is that in the last time we saw the VAT hike, the 1% VAT hike, you actually only saw a 0.6% pass through to the consumer, which means that a lot of the retailers actually took a slight margin hit in order to help consumers along. And I wouldn't expect that to be any different this time.
Let's move to Stor-Age, a stock I own and like. Had an update this morning. Not a huge amount of detail. Chantal, I got to say, I thought local operations were better than expected. They do point out that this is seasonally a soft time for the UK. What did you make of the update? What do you make generally of Stor-Age?
Yeah, I mean, a very consistent update, and that's something that we've gotten used to from this company. We get consistency. You kind of know what your dividends are going to look like. There's never a super negative surprise, but there's never a super positive surprise on Stor-Age's numbers either. So if you're looking for kind of just the consistent, like a decent yield and consistent low kind of growth, this is probably the company for you. They tend to be more defensive than other REITs because of the death, divorce, disaster kind of exposure that Stor-Age has relative to shop that a big retail REIT would have. So yeah, a bit of a more defensive story, and in line with what we would have expected from the company.
Alex, Stor-Age, I mean, it is very much more niche, as Chantal says. It's not the sort of classic sort of REIT, very niche, got the UK operation. Your take on Stor-Age?
I used to be very bullish on the stock, especially when it came to the market in a few years after that. I think in SA they've got a very strong brand presence, and if you look at the quality of their buildings and the IT side to it, they leaps ahead some of their peers. The UK strategy, I'm not entirely convinced about. I mean, it's a bit of a mix of brands they've got there. A lot of it is all brownfields that they've bought over. So you don't really have a full sense of the locations and so forth compared to an SA. So I'm not too sure. They make the argument that the valuation should be much higher for those assets. I guess all African property companies have said that when they've ventured offshore. And you've seen the slowdown in the growth as well in distributable earnings per share over the last few years. So I think it's pretty much fair value at the moment for me. At the moment, if there's a material pullback, then perhaps I'll have a look at it. But at the moment, I think it's fair. And you also saw, I think the payout ratio got reduced at the last set of results. It's because they're not generating enough cash at the moment. So they have to have something back, hold something back for future growth, or just to keep the balance sheet very strong. So yeah, I'm a bit lukewarm at best, I would say.
Alex, stay with you. We had Sibanye results on Friday. Question was coming through. Is this a worst case scenario and the future looks brighter for Sibanye? I would wager that what Sibanye needs perhaps more than anything is a PGM price going in the right direction. They're doing what they can. But I mean, is there an investment case, or is it really a case of watch the white metal?
Well, so to answer the worst case, no. I mean, things can certainly get a lot worse than it is. I mean, despite the very strong gold price, I mean, gold is still not generating, I think, free cash flow. So that tells you how those assets are extremely highly geared. And obviously, PGMs, as you allude to, are under pressure. So, but if gold can remain at these levels, we're seeing perhaps even stronger, and we see a bit of a pick up in specifically platinum, which has been laggard, then perhaps. But they've got a lot of leverage issues there, and still got some questionable corporate action decisions they want to take. So it's a tough one. It's highly geared to any movements in those prices. So if you are bullish, gold and PGMs perhaps worth looking into. But there is quite a lot of downside risk, I would also say, if things do go wrong. So for me, I would say very low in the quality tier and probably high on the risk tier.
Yeah, I take the point in that. Chantal, Sibanye-Stillwater?
Yeah, I mean, if PGM prices can get some sort of go forward momentum, I think this is one of the stocks that would probably benefit the most because they're the more marginal producer and they're highly leveraged. Gold is now such a small part of their business. And as Alex mentioned as well, they're not really generating any free cash flow from the gold business. I mean, just for context, all-in sustaining cost, for example, for most of the gold mining peers that are listed is around about $1,600, $1,700 an ounce. So they are absolutely printing cash at current gold prices. But Sibanye's gold operations, all-in sustaining costs are, I think, $2,300 an ounce. So yes, there is room there, but much less room to maneuver. So yeah, I think the big catalyst for this stock will be sustained higher PGM prices.
Yeah, and we've been waiting for those for, I mean, it feels like forever and a day. Yeah. Chantal, staying with you, question coming through. Shoprite having results next week. Trading update looked fairly good. Surely it is a good opportunity below 280 Rand. I don't think Shoprite really pops on results in the sense of what we might see at Walmart or something, but Shoprite at sort of sub 280?
Yeah, I think that results could be a catalyst for a resumption of the bull trend that we've seen over the last few years. So definitely some pressure and probably a little bit of disappointment in the share price performance over the last few months. And I mean, this is a high quality stock. They're pumping along nicely. I think the last 3 or 4 years when we've had results from Shoprite, they've generally exceeded market expectations. So if they can continue with that, I would expect a resumption of the bull trend. That said, the stock isn't particularly cheap on a fundamental basis. It looks a lot more expensive than its peers. And if you see any sort of weakness, I think that you can actually you can see a further pullback. Longer term, though, I'm still very happy to own the stock. And if you are going to be a holder for a very long time, this could offer an opportunity.
Yeah, Shoprite, one of those, it sometimes gets cheapish, but it's certainly never cheap. Alex, Shoprite in the 270s?
The viewers just need to remember that food inflation has come down quite a lot, so you're going to see lower revenue numbers compared to what you've seen in the recent past. So that's important. But Shoprite will probably continue to still grow volumes, as we've seen in the update. So I think it will be operationally still a sound update. There will be savings from lower load shedding compared to prior years. But knowing Shoprite, they'll reinvest in efficiencies and look to put the competitors further under pressure. So they'll eke out, I think, a decent update. If it will be enough for shareholders, time will tell. But certainly on a medium to long term basis, I think the business is still very well positioned. And if there's any material weakness, you should look to buy.
Yeah, it is, just for fun fact, my longest holding. I bought it 21 years ago, 8 Rand a share. Let's go to some stock picks. Alex, Nedbank.
Yeah, so we spoke about some of SA Inc. stocks being under pressure since beginning of year or even Q4 last year. And I think Nedbank also falls in that camp. They don't need to do a lot right here, in my view, to produce decent upside. So if pretty much any of the banks produce, call it earnings between 5 and 10%, I think they're undervalued. So if we are moving in an environment where economic growth is going to be, call it 1.5 to 2%, I think it's very likely that these stocks will be able to generate that type of earnings. Credit losses seems to be well controlled.
Yeah.
They don't have too much exposure to the likes of Africa compared to a standard bank. And I think, they're relatively well positioned, specifically also if they're big corporate spending on infrastructure. So I like Nedbank. You don't need to be aggressive to make quite decent double-digit returns.
Chantal, Pan-African had results recently. The big story for me was that hedge is gone this week, I think. They, of course, are the low-cost producer and your stock pick today.
Yes, so thank you for outlining my entire investment case for me, Simon. Yeah, I mean, that the hedge is gone. So that has been a big inhibitor for Pan-African over the last year and a half. And the reason they had that hedge in place in the first, the hedge in the first place is very important. They forward sold their gold at $2,300 an ounce, right? So they didn't benefit fully from the upside, but they used that money to invest in growth projects. So they invested in a Evander mine and they invested in a tailings retreatment plant. And this is going to result in their all-in sustaining cost coming further down. And it is going to result in their production profile growing probably at the fastest pace of the SA gold mining peers. So in the event that the gold price stays elevated, which we think there's a good case for given the geopolitical chaos across the world right now, and the fact that central banks are still buying up gold because of the kind of fractured geopolitics. So it's not just safe haven, it's central bank buying as well. We don't see a lot of downside risk to gold prices at the moment. We don't see a lot of upside to gold prices either. But if a company can produce gold at an all-in sustaining cost of $1,400 to $1,500 an ounce, and the gold price is close to $3,000 an ounce, the math just makes sense.
Yeah, it's called printing money where I come from. And actually, I spoke to Cooper's Lewis, and he said that lack of hedge adds about 50 to 60 million a month to their income. That's all for Stockwatch today. Thanks to our guests, Alex Duys from Umthombo Wealth, going with Nedbank, Chantal Marx, FNB Wealth and Investments, going with Pan-African Resources. Up next, the close. Stay watching.